Hi friends, welcome to my channel. So today we will learn about the technical analysis. Before watching this video, please watch the fundamental analysis versus technical analysis to gain a better understanding of this video. I will give the link in the description below. So the technical analysis helps us to identify the price at which one should buy or sell the stocks and the expected risk and the reward and the expected holding period. The technical analysis are used mostly by the traders than the investors. One of the greatest advantage of the technical analysis is that we can apply technical analysis in any asset classes which has historical data. This is like how we learn to drive a car. Once we learn to drive a car, we can drive any car. Technical analysis works in the same way. Unlike fundamental analysis, technical analysis do not worry about a company's valuation. The only thing that matters in the technical analysis is the stock's historical trading data and the insights the past data provides about the future movement in the stock price. The price action in each stock can be identified by the candlesticks. Candlesticks are represented in different time frames. But let us discuss the daily time frame for now. There are 4 parts to a candlestick. The first is the open price. When the markets open for trading, the first price at which a trade is executed is referred to as the opening price. The second is a high price, which shows the highest price at which a trade occurred. Third is the low price, which represents the lowest price at which a trade occurred for the given day. And the last is the close price, which is the final price at which the market closes for the day. If the close price is higher than the open, it is considered to be a positive day. Otherwise, it's a negative day. The close price actually shows the market sentiments and serves as a reference point for the next day's trading. For these reasons, closing is more important than the opening, high or low. There are few other types of chart patterns like line charts and bar charts other than the candlestick chart. The line chart is the most basic chart type and it is formed by plotting a stock's or the index closing prices. A line chart can be plotted for various time frames like monthly, weekly, hourly, etc. The main advantage of a line chart is its simplicity. That is, through a line chart, a trader could identify the trend very easily. The main disadvantage is the line chart does not provide any additional detail and it takes into consideration only the closing price, ignoring the open, high and the low prices. As a result, traders usually don't prefer the line charts. The bar chart, on the other hand, shows the open, the high, the close and the low prices. A bar chart has 3 components. One is a central line which connects the highest and the lowest price. The left mark indicates the open and the right mark indicates the close. The main disadvantage of the bar chart is the visual appeal. It is difficult for a trader to get all the details by looking at a bar chart as the bar charts are confusing. As a result, most traders do not use the bar charts as well. So the candlesticks are the most commonly used chart patterns and in the upcoming videos, we will be discussing only about the candlestick patterns. The candlesticks have originated from Japan. In a candlestick, the open and the close prices are displayed by a rectangular body. Candlesticks are classified as bullish or bearish candle. A bullish candle is usually represented by a green color and the bearish candle is usually represented by a red color. A candlestick is made of 3 components. One is the central real body, is rectangular in shape, connects the opening and closing prices. For a bullish candle, the opening is at the bottom end and the closing is at the top end. Second is the upper shadow, which connects the high point to the close. And third is the lower shadow, which connects the low point to the open. This can be understood with an example. Let us assume the prices are as follows. Open equal to 60, high equal to 70, low equal to 54 and close equal to 63. This indicates a bullish candle as the close is greater than the open price. Likewise, the bearish candle also has 3 components. The central real body which connects the opening and closing prices. For a bearish candle, the opening is at the top end and the closing is at the bottom end. 2 is the upper shadow which connects the high point to the open. 3 is the lower shadow which connects the low price to the open. This is what the candlesticks look like in a daily time frame. The green candle indicates bullishness and the red candle indicates bearishness. Regarding the selection of the time frames, usually long-term investors select weekly or monthly time frames. Swing traders select 1 hour, 4 hours or daily time frames. And intraday traders select 1, 5, 15 or 30 minutes time frames. For example, if you take a daily candle, then the opening price of the day is the open and the highest price during the day is the high. The lowest price during the day is the low and the closing price of the day is the close. The main reason for using the candlestick pattern is based on the assumption that the history tends to repeat itself. We will explore this a little further. Assume that on the date of 22nd March, a stock started falling for 4 consecutive days and reached a support level. On the 5th day, the stocks fall on relatively lower volume, and on the 6th day, let us assume the stock rallies towards a positive close. So as an outcome, we could conclude that there is a probability that the stock could go up on the 6th day. So the next time when the same set of factors is observed for the 5 consecutive trading sessions, then we can expect the stock price to go up on the 6th trading session. So this is in the assumption that the history tends to repeat itself. Candlesticks can be broken down into single candlestick pattern and multiple candlestick patterns. The single candlestick patterns which are commonly used are Marubozu, Doji, spinning tops, shooting stars, hammer, hanging man, etc. And the multiple candlestick patterns are a combination of multiple candles. Main patterns under the multiple candlestick patterns are: 1 is the engulfing patterns, 2 is the harami pattern, 3 is the morning star, 4 is the evening star, M reversal, W reversal, etc. So there are many other patterns also, but here we are going to discuss only the ones which are commonly used. So we will discuss about the single candlestick patterns in the next video. So that's it friends. Hope you got some information from this video. If you like these kind of contents, please consider to like, subscribe and share these videos. Thank you for watching. Have a wonderful day.